What's going on YouTube? Taxes can be complicated, but I'm here to make it easy. In today's video, we're going to talk about the different ways that you can pay less taxes as a real estate investor. My name is Sean and I make real estate easy. My wife and I own 34 units across the country, and by owning so many rentals, we're able to get many of the tax benefits of being a real estate investor. Before we get into it, let's explain why we get so many tax benefits in the first place. That's because the government actually wants you to become a real estate investor. Why? It's because we're providing good, safe housing for people who can't afford homes of their own. Providing housing to our tenants is considered a public good and allows them to continue to focus on getting more jobs and providing for the economy. So to incentivize us to buy more rentals and invest in housing, the government gives us tax breaks. For this video, we're going to be talking mostly about long-term rental properties that you hold on to for at least a year. These strategies may not work for you if you only plan on wholesaling or flipping houses. So be sure to watch this video all the way to the very end so that you can know exactly what to do to maximize your tax savings. And of course, please consult with a tax professional before trying to implement any of these strategies. The first method that you can use to save on your taxes is a Section 121 exclusion. Now this one is cheating a little bit because it's not really for rental properties. This one only works if you live in your property for at least 2 out of the past 5 years. So what is a Section 121 exclusion? It basically states that when you sell a property, the first $250,000 is excluded from your capital gains taxes, or $500,000 if you're married and you file jointly. So what does that mean exactly? Well, it means that if you bought a home for $500,000 and you sold it after living in a home for 2 of the past 5 years for $750,000, then you don't have to pay any of the taxes on that $250,000 gain. It's the best tax deal because unlike the other tax reduction strategies, there are no caveats to this. This strategy works great for anyone who's just getting into real estate and plans on house hacking or renting out their primary home after living in it for a few years. So you could have bought the property, lived in it for 1 year, rented it out for 3 years, and come back and live in it for 1 more year and then sell it. Or you could have lived in it for 2 years, then rented it out for 3, and then sold it in the 5th year to still get this benefit. Now, this strategy actually works for anyone who has been on title, who has been living in the property for 2 out of the past 5 years. So this means that you don't have to be married to each other. You could have bought this property with some friends, or you could have bought it with some siblings, and each one of you can get that $250,000 tax-free. It's a great way to build wealth, and this works especially well for people who are house hacking because you're buying the property and you're living in it anyway. And then when you sell it, you get this huge tax benefit. Now, the second way that you can save on your taxes is by being able to write off your business expenses. As an example, if you have properties out of state, then anytime you fly to that state, any meals or travel expenses related to that are all write-offs. And this is great if you're often traveling to another city anyways. For example, if I really like going to Orlando, Florida, and I have a rental property in Orlando, then every time I fly there to visit my property, I can write that off. And if I just so happen to go to Disney World while I'm there, well, I still get to write off my trip. So there's actually a whole list of business expenses that you can write off when you own rental properties. I recommend talking to a CPA to see what you can and can't write off so that you don't get too creative and get in trouble with the IRS. But generally speaking, anything you spend on your business that's business related can be written off. Now, the next way to pay less taxes is by paying less property taxes. Property taxes are one of those expenses that you have to pay on your property no matter what and no matter how long you've had the property. And unfortunately, it grows every single year. But if you understand the next few strategies, then at least you can pay less in these property taxes. If you own a property in California, there's something called Prop 13, which states that when you buy a property, then your property taxes are only going to be 1% of the purchase price. And then because of Prop 13, your property taxes can only increase by 2% a year. So that's how people who own properties that are worth millions of dollars still only pay a few $1,000s in property taxes. It's because Prop 13 has frozen their property taxes when they bought it, and it only grows by 2% a year. Then there are other propositions like Prop 19 that keep your property taxes frozen even as you transfer the property to your descendants, like your children. Now, the rules around this are very strict, and if you don't transfer your properties correctly, then your property may get reassessed and you'll permanently have higher property taxes on it. Another thing that you need to know is that if you're in a state that reassesses property taxes every time, meaning that every year as the property value goes up, your property taxes go up as well, then you also need to learn how to appeal your reassessments. This is particularly important in states with high property taxes like Texas. As an example, we have a friend who invested in Austin, Texas a long time ago, and at first her property was doing well and was cash flowing positive, but since then her property value has doubled, which also made her property tax double. Now, it's nice for her because she has a lot of equity, but it's also bad because her property can't support its own payments anymore. So now she's losing money every single month by paying it out of pocket. So when your property gets reassessed, you should try to appeal it. Usually when you appeal, they'll ask you to justify why you think your property is worth less than what they're assessing it at. If the reassessment is much lower than the actual market value, then appealing can actually be risky since they might take another look at your property and charge you more for property taxes. So you need to decide if this is worth the risk or not. To appeal our reassessments, we've been using this company called Ownwell. They're pretty nice and they will appeal on your behalf, and they're only going to charge you 25% of the savings that you get. So as an example, if your property tax increased by $1,000 more than the year before, and they're able to lower it by $500, then they'll only charge you 25% of the $500, which is $125. So it's like a win-win situation, and they'll only charge you if you end up paying less in your taxes. And you can check this out with the link down below. Now, the next way that real estate investors save on taxes is through depreciation. Depreciation is where the government allows you to write off the value of the structure by 27.5 years. So if you bought a property for $500,000 and the land value is $200,000, then the other $300,000 is for the value of the actual structure on the property. So using depreciation, you can then write off $300,000 over 27.5 years every single year. So if you happen to make $12,000 in net profit, then you could deduct that by $10,100 and only pay taxes on $1,900 that year. An important note about depreciation is that you do need to pay this back eventually when you sell the property through something called depreciation recapture. The way that they charge you is when you sell your property, your basis gets lowered so that you pay more in capital gains taxes. As an example, if you bought your property at $500,000 and you depreciate it over the full 27.5 years, then by the time you sell it, it'll be as if you bought the property at $200,000. So you have to pay $300,000 more in capital gains taxes, which sucks. But if you stay until the end of the video, we'll tell you a way to get around that. Another thing that you can do is something called accelerated depreciation. So let's say that people don't want to wait the 27.5 years to depreciate the full amount and only get $10,900 every single year. What they can do is accelerate depreciation by writing different things off in different time schedules. So as an example, let's say your building structure framing is good for 27.5 years, but what about the light bulbs inside? What about the HVAC system? These things have different lifetimes than the actual structure. So you can write those things off on a different schedule and get more depreciation for your first few years and therefore pay less taxes on those first few years. And you do this through something called cost segregation, where someone goes into your home and looks at every single part of your home and says, okay, your light bulbs are good for 5 years, your HVAC system good for 15 years, and your water heater is maybe only good for 10 years. And then you pay that much less in taxes in your first few years. Now, one big downside of depreciation is because it's a passive loss, then if you're working full time, you can only write off as much as you earn from your passive income through passive activities. So with your rental properties, you can only write off as much as you get from your rents. Anything over that amount can only be carried over to next year. But if you do this one thing, then you can actually write off the money that you get from your active income. And that's by being a real estate professional. A real estate professional is someone that spends a majority of their time in the real estate industry. An example of this is if you're a real estate agent, a full-time property manager, or a full-time real estate investor, then you can actually write off any passive income losses from depreciation against your active income. The 3 tests of qualifying is if you've worked at least 750 hours in the real estate profession, 50% of your time is towards that profession, and 3, you're actively doing material participation. So you're actually doing something with real estate during that time. Now, most people who have full-time high-paying jobs, such as doctors, lawyers, or engineers, fail the 50% test because it's hard to justify that you have a full-time W-2 employment and are still spending more than 50% of your time as a real estate professional. When the IRS sees that, they flag it and they usually don't let it fly. But what you can do is if you're married, one of you can be a full-time real estate professional and not have a full-time job, while the other person does, and your spouse's professional status can help write off the other spouse's W-2 income. And that's actually what a lot of people with high salaries do. One person is a full-time, maybe stay-at-home parent, and they apply to be a real estate professional. Their real estate professional status can help write off their spouse's W-2 income, which is huge in tax savings, especially when you combine it with cost segregation to write off more during the first few years. Okay, the next thing that you need to know about saving taxes is something called a 1031 exchange. What a 1031 exchange does is allow you to sell a property and buy another one without having to pay capital gains taxes in between. You defer the capital gains taxes to then buy a bigger property. In a normal scenario, let's say you bought a property for $100,000 and then sold it for $750,000. Normally, you'd have to pay taxes on the $650,000 worth of gain, which would be around $230,000, leaving you only around $520,000 to then buy another property. But if you do a 1031 exchange, then you can sell your $750,000 property and use the entire amount to buy your next one. So this lets you buy a more expensive property with the same sale, which means that you get more rental income and potentially allows you to buy a property with more appreciation potential. And the best part about this is you can continue doing a 1031 exchange over and over and over again, which lets you continue to buy more and more and more. And finally, we get to one of the biggest reasons why you should invest in real estate. You can create generational wealth through the step-up in basis. A step-up in basis is when you pass away and your heirs inherit the property. Their basis jumps up to the current market value and they don't have to pay taxes on any of the gains that happened during your lifetime. So we mentioned earlier that when you do a 1031 exchange, you sell a property and you buy another one without having to pay capital gains taxes in between. So by the time you're at the end of your life, you'll probably have made millions of dollars. But with a step-up in basis, when you pass away, all of those millions of dollars of gains now go to your heirs, but they won't have to pay taxes on any of those gains because the basis has now increased to the current market value. As an example, if the properties were purchased for $200,000 and are now worth $1 million once you pass away, then your heirs will inherit the properties as if they bought them at $1 million. So they'll only have to pay capital gains taxes if they sell the properties for anything over $1 million in the future. Understanding the tax code and understanding how you can benefit from real estate investing is incredibly incredibly important to making more money and creating generational wealth. Feel free to rewatch this video multiple times if you need to, but also let me know if you have any questions about any of the tax strategies that I shared in the video down in the comments below. I'm not a CPA, and there are some things that you need to do in the right order, otherwise you may miss out on some tax benefits with no ways of going backwards. So I highly encourage you to talk to a tax professional before trying to execute any of these strategies. And if you're interested in saving more money and pay less for your home insurance, you definitely want to check out this video over here. Thanks for watching. I appreciate you, and I'll see you next time. Take care.